Our first speaker was an international fencer. Interesting. Now he plays squash. It's Richard Broughton. Richard, over to you. Please put your hands together.
Thank you very much. I was not a very good international fencer, that's why I'm here, I suppose. So today I'm going to be talking a little bit about the US market. Now, I normally, at some point in these presentations, make a note that the US TV market and the European TV market are very, very different. They're structurally very different. There are different players, there are different scales, different dynamics. But there was a deal that was made at the end of last year between Charter Communications, one of the US's leading cable companies, and Disney. That was a little more unusual, and I think it's worth talking about. And this deal saw the renewal of the distribution of Disney's broadcast channels, so ABC, ESPN, and so on, via Charter's cable TV network. But it also saw the inclusion, for the first time in the US, of Disney Plus, the ad tier, within one of the basic Charter Communications TV packages. Saw the inclusion of ESPN Plus within one of the higher tier packages within Charter's TV service, and a future ESPN direct-to-consumer streaming service would be included within one of the basic Charter packages. So it's unusual for a few reasons. One is just the sheer scale of this deal. This deal is worth about $2 billion to Disney per year. Charter is not one of the largest cable companies in the US. It's one of the largest pay TV operators globally, ranked number 2 in revenue worldwide. And it's also unusual from Disney's perspective. Disney Plus is very rarely hard bundled. It's very rarely included in core pay TV packages anywhere in the world. There are a handful of those deals, and particularly not in the domestic US market, where its brand is arguably the strongest. So what led us to that point, and what are the implications for some of the international markets? So let's have a look at some of the background to this. So we take a look at cord cutting in the US. That's one of the key themes that has driven the market over the last few years, that influenced the trajectory and the strategies that different programmers and the different cable companies have taken. So the chart that we've got up on screen here is illustrative of the number of pay TV subscribers in the US, so the number of cable, satellite, IPTV customers, so Comcast, Charter, DirecTV, and so on, and how they've trended over the last few years. So if we take a look back to 2012, 2013, the market about a decade ago peaked somewhere around about 100 million subscribers. Since then, every year, the industry has lost TV subscribers. So by the end of 2023, we were down at about 63 million pay TV subscribers. And by the end of 2027, we're probably going to be down by about 60% on the previous total. So the market's probably going to have stabilized, or at least at that point, got down to about 40 million pay TV subscribers. Now, even if you're charitable and start to include some of the lower cost virtual cable companies, the likes of YouTube TV or Sling TV, the market will still have declined by about 40% on its peak by the time we get through the next few years. So very serious levels of cord cutting. Now, pay TV operators have typically been able to respond through increasing pricing. So in the early years of cord cutting, pay TV groups were able to, every time they lost a subscriber, they put the prices up a little bit. You lose another subscriber, you put the price up a little bit. So each year they were increasing prices by maybe 3%, maybe 4% a year. And this was able to offset some of the worst impacts of the cord cutting. But over the last couple of years, a combination of competition and simply cost of living was really impacting the ability of pay TV operators to continue to increase prices. So we're looking at maybe price increases of perhaps 1% per year. So operators are no longer able to offset the impact of cord cutting by simply increasing pricing. So if you can combine those two trends, you can see the impact that it has on programmers, because programmers in the US very much contingent or very much dependent on the fees, the affiliate fees and the retransmission fees that cable companies and satellite companies pay them. So subscriber money comes in, some of that money is then diverted into paying for the ABCs or the ESPNs of the world. And that revenue hasn't declined quite as rapidly as the wider market, or at least in terms of subscriber numbers, for a few reasons. One, because those price increases have helped offset some of the worst effects of the subscriber changes. Also, pay TV operators have eaten into their margins just a little bit. But we've still seen about a 3% decline in the amount that pay TV operators and virtual cable operators spend in aggregate on programming, on these affiliate and retransmission fees in the US. So the market's certainly not been growing, it's been steadily sliding. And this means negotiations for renewal, for distribution, become increasingly more fraught. So if you're a cable operator, you don't want to increase your fees when a group like Disney or Warner comes back to renegotiate. So you're going to stand your ground and say, well, we're not making any more money. We don't see why we should pass any more on to you. So of course what happens here is that the programmers themselves will say, well, we've got to pay our bills, we've got content creators, we've got sports rights to afford, we need those higher fees. And you end up with retransmission disagreements. You end up with blackouts, that as the deadline for the negotiation is reached, the two sides have hit an impasse and the channels go dark. And then miraculously, a week or two later, everyone reaches a deal and the channels go back on air. But this is becoming increasingly common, and that's generally a sign of how challenging the economics are, both if you're a pay TV operator and if you're a programmer in the US. Now, of course, it's not just about affiliate and retransmission fees. It's not just about the subscriber fees that come in and get diverted into the programming. It's also about the advertising revenue. And of course, alongside the subscriber shifts, the cord cutting, we've seen a migration of viewers over to streaming services, and that's pulled audiences away from broadcast TV. And the same trend is happening with the broadcast advertising market in the US. It's slowly sliding. So if you're a linear programmer, if you're a linear broadcaster, you've seen the market decline from maybe $68, $70 billion back in 2016, down to maybe $59 billion in 2022. So the market, both for subscriptions and for ad dollars, has been dwindling. Now, I'm probably not telling you anything particularly new here. This has been happening for a while, and I'm sure cord cutting is well understood by everyone in this room. What is happening, though, is the impact of this has begun to accelerate slightly. So if we look at the last 5 years, we can see that the market for linear broadcast revenue sources dropped by maybe $6-7 billion, down from about 131 billion in 2018 down to $124 billion in 2022. And we can see the market shrinking in terms of the ad revenue in that green block at the top, and there's retransmission and affiliate fees, so the pence per subscriber that's paid to the channels from the cable operators in the blue and pink at the bottom. But over the next 5 years, cord cutting is continuing. Those price rises can't continue, and the ad market's continuing to shrink. So we're looking at probably about a $19 billion a year shortfall over the next 5 years that needs to be filled with something else. Now, of course, the effects of these declines are going to be felt in a number of different ways by media groups and by consumers. If we think about the perspectives from a linear TV network, you're going to start to see further high-profile blackouts. These negotiations are getting more and more fraught. For many programmers, it's existential. They need the higher fees to continue to operate. So brinkmanship is going to be the name of the game. We're going to start to see declining commissioning, acquisition, and sports rights spend from many networks. If they're not getting the higher fees, they can't justify spending on content, so they're going to reduce their expenditure, their outlay on content, and that's going to be felt by consumers. We're going to see potentially the divestments of major or by major media groups of some of their channel networks. We saw earlier this year or last year, Disney was considering spinning out ESPN. And lastly, we're going to see the closure of secondary cable networks. There'll be some groups that just can't find buyers. We've already started to see this with regional sports networks in the US. Some of them are beginning to close. They just can't continue operating. Now, if you're a programmer, you're a studio group, actually this hasn't bothered you too much to date because of the positive impact of streaming. So if we take that previous chart, where we're looking at the linear revenue sources, and we layer in the subscription streaming and the ad-supported streaming revenue sources, how much they're spending on content or how much the direct-to-consumer services are making, you can see the market's grown pretty substantially over the last 5 years. Instead of seeing this $5-6 billion decline, we've seen significant growth. Third-party streaming content spend, so this would be Netflix or Apple or Amazon buying content in or commissioning content. And direct-to-consumer streaming revenue, so the streaming services are operated and owned by the studio groups themselves, have more than made up for this decline, this shortfall in the broadcast TV market, both from advertising and from the affiliate fees. So if you're a studio group, you're a programmer, and you look at the amount of money that you've been making from distributing content, whether it's a channel, whether it's content sales, whether it's program creation, you can see the market's grown by about 20% over the last 5 years. So this is direct from the company filings. So all of their affiliate and retransmission fees, all of their distribution revenue, their direct-to-consumer and other related revenue has grown by about 20%. So why are we talking about this deal now? Well, because in the last year, things have changed. You'll probably have noticed that most of the slides up until now have been focused on 2022 and before. Whereas what happened in 2023 is the engine of growth for the TV market, the subscription market, ceased to grow in the US. So the chart here is just looking at two things. One, in the light blue, the number of subscribers to subscription streaming services like Netflix, Amazon, Apple, Disney Plus, and so on. And in pink, the number of new customers those services added in aggregate in the year. So in 2020, it obviously peaked. We're looking at somewhere in the region of about 100 million new subscribers in 2020 as everyone took out subs during lockdown. 2021, it wasn't bad. It was about 80 million. 2022, it was okay. It was 60 million. 2023, dropped below 20 million new subscribers. So a significant decline in the growth rate of the subscription streaming market. So if we now take a forward-looking view to the next few years about what that does to the addressable pool of revenue, if you're a studio group, if you're a programmer, if you're a channel group and you're selling or trying to make money from your content, we're looking at a market that, unless something changes, will not grow. So in 2022, the market, all of those revenue sources, the affiliate fees, the advertising revenue, the content sales revenue that you can generate from selling to streaming services was worth about 176 billion. Over the next few years, we're seeing the market grow by maybe 1% if nothing changes, because cord cutting is going to continue to erode the ability of pay TV groups to spend on broadcast channels, and the streaming market is not growing as rapidly as it used to. So it's just about offsetting that decline. But in real terms, we're looking at a market that may shrink unless the programmers and the cable companies can reach some sort of agreement to change the situation, to break the cycle. And breaking that cycle is important. If we think about from a consumer perspective, you're looking at your pay TV operator and all the channels it carries, and each year the number of channels it carries decreases a bit, the quality of the programming on those maybe decreases a bit. Increasingly, you're going to look at the streaming world and think, well, maybe I'm just going to switch over and cancel and cut the cord. And of course, that's a cycle. You cut the cord, the cable companies have less money to spend. They pass less on to the programmers spend less on content, the streaming services look more attractive, and so on. So enter the Spectrum or Charter Disney deal. So if we think about the two companies in the US, Disney has about 42 million streaming subscribers in the US. Spectrum has about 14 million cable customers. About 4 million of those Spectrum Charter customers already have Disney Plus. They're spending on top of their Charter and their Spectrum subscription to get access to Disney Plus. Most of them are taking the premium tier. Now, they're a risk factor if you're a cable company, because these Disney Plus customers are pretty likely to have Netflix as well. They're pretty likely to have Amazon. Maybe they've got Max. Maybe they've got Apple TV Plus as well. But if you take one streaming service, you're pretty likely to take a couple more in the US at least. So you're at high risk of cord cutting. So those customers are most likely to be dissatisfied with their offer. They're already spending a lot more on other programming services. It's a small step to cancel their cable subscription and just go direct to consumer or direct streaming services only. So what do? Well, if you're Spectrum and Disney, the point at which the deal renegotiation rolls around, you need to reach a new agreement for ABC, for ESPN, for National Geographic, and so on. You integrate some of those streaming services into your core cable packages, and that means that for the majority of the customers in your cable customer base, they're now slightly less likely to churn than they used to be. They've suddenly got access to Disney Plus. Some of them in the higher tier packages have got access to ESPN Plus. And in the event that ESPN is taken, and all of the sports rights that are core to many of your customers are taken direct to consumer in their own streaming service, in the event that they go outside, you can bring them into the fold as well. You can bring those customers back. So for Charter, for Spectrum, we're looking at about 10.5 million customers who've now got access to Disney Plus, the ad-supported version, through this new deal, and a much smaller number who've got access to ESPN Plus. Now that's good news for Disney Plus as well, because if we look at what's happened to Disney Plus's subscriber base over the last couple of years in the US, it hasn't been very exciting. It's stabilized at about 42, 43 million, but we can see the impact that this is likely to have in Q1 of this year, where it will spike by about 7 million new subscribers. So we'll come on to the economics of this in just a moment. But why is it happening now, and why am I telling you about the US operations? Well, it's happening now, partly for the reasons we've already discussed, but saturation is obviously a big driver of this. If you're Disney and your subscriber base has been flat for the next few years, it's quite clear that you can't grow your subscriber base organically anymore. You need to be looking to alternative distribution mechanisms and alternative ways to improve your subscriber growth. So a distribution deal is one way of boosting growth. The other is the ad-supported tiers. So I'm going to come on to the economics of the ad-supported tiers in a moment, but our view is that these make such deals more likely than they used to be. Now, saturation isn't just a US trend. We've seen it most keenly in the US with that plummeting number of net additions in 2023, but that same effect is being felt in every market worldwide. So the chart here is just illustrating the number of subscription streaming net additions in the different regions around the world. We can see North America on the right-hand side of this chart here. Those are the same numbers that we saw earlier on. But we can see exactly the same sort of pattern with regards to the net streaming additions in Central and South America, in Western Europe, in Asia Pacific. So some of these trends that are influencing streamer willingness to do distribution deals are, of course, occurring in other markets around the world. Now let's have a look at what happens when we do the deal, or look at the economics of the deal for an ad tier versus a not ad tier. So if we take the deal without the ad tier, so these are hypothetical numbers, these are really just to prove a point. I've really simplified the Charter deal down. Let's just imagine it's occurring with Disney Plus. Ignore the ESPN, ABC, ESPN Plus elements of the deal. Let's just imagine we're talking about Charter Select taking on Disney Plus. And we're going to imagine two scenarios here. We're going to imagine a world in which the deal was purely done with the Disney Plus premium streaming service. And then we're going to imagine the economics of how that looks with the ad tier, which is what's happened. So let's imagine this world in which the Charter Select package of subs, or the Spectrum Select package, get Disney Plus Premium. So they're $13.99 a month, no ads. Now those new subscribers, let's imagine that Charter is now saying, well, we're not going to pay full retail price. Some of these subscribers didn't want Disney Plus really in the first place. They're not going to be willing to countenance our fees going up. So let's imagine that this deal is done in such a way that Charter is paying half price. It's probably a little bit less actually in reality, but let's imagine they're paying half price for this. So instead of $13.99, they're paying half of that, so about $7 a month. So the incremental impact for Disney Plus in terms of their revenue, you take the 10.5 million subs that are on the Charter or the Spectrum Select package, you multiply that by the $13.99, divided by 2, and you subtract the revenue that the existing 4 million Charter subs who were already taking Disney Plus Premium were generating. And you get an incremental impact in this scenario of about $200 million a year. So by making the deal under these considerations, Charter makes, or Disney makes, a little bit more money than it would have done without making the deal. Okay. What does it look like with an ad tier? Well, let's imagine in this case that all of the customers, as they have done, have got Disney Plus ad tier. The new subs generate revenue at about 50% discount again, so let's take that same assumption. So instead of $8 a month, it's $4 a month. What's the incremental impact for Disney Plus? So you go through the same calculation. It's 10.5 million times your $8 a month times your 50% discount. You add in your ad revenue from those subs who are watching Disney Plus, and you subtract the existing premium revenue that those customers were making. So let's assume that all of those premium customers have shifted over to the ad tier. You get an incremental impact under these assumptions of $300 million. So we can see that under the various different assumptions we've put in here, the deal makes a little bit more sense because the ad revenue generates, the ad tier generates a little bit more money. And once you've taken into account the discount that those subscribers are feeling, or that Disney is feeling in terms of the revenue that it's generating, we can see that the ad tier structure is just a little bit more attractive to streamers. So some of these changes are likely to be reflect a more general strategic shift in the industry, and these are going to have implications globally. Now, it's worth noting we're already beginning to see hard bundles occurring internationally. This sort of deal is a little bit more unusual in the US. It is happening in Europe, in Asia already. But the fact that it's occurring at such a scale in the domestic US market is a good indication that the streamers have given up on a pure D2C model. They're looking at distribution deals as a way of dealing with saturation, subscriber fatigue, and some of the stacking issues that they face in many markets. And it's worth noting on this basis that pay TV operators are a much stronger proposition internationally. We're not seeing the same mass market cord cutting. We're not seeing pay TV operators losing subscribers hand over fist every year. So they represent much stronger distribution partners. They have exclusive content, and they're in markets with lower underlying stacking rates and willingness to spend. And lastly, the steady rollout of the ad tiers globally makes these models more attractive to streamers. They're no longer just focused on subscriber growth, that premium subscriber growth. Reach becomes a much more important factor. When you can monetize your subscribers through advertising, you're focused on breadth, how many customers can get this, as opposed to purely how much you can monetize the customers at the top end. So I hope that's been useful and set up the day nicely. Thank you very much.